Financial institutions just tapped the Federal Reserve's standing repo facility for the largest amount ever since its creation. Take a look at this chart. You can see the Fed's standing repo facility rarely gets any use. Recently, it has been getting more and more use until Friday, October 31st. We had a massive record spike. Zooming in on just the recent time period, you can see that even though Monday, November 3rd saw a decline in usage, it was still higher than it's ever been. If that's all Greek to you, basically it just means that liquidity in the financial system is so low right now, banks are running to the Federal Reserve to get the liquidity from them because they can't get it from each other. The question is, number one, why is this happening? And number two, should you be concerned? The first thing to know about why this is happening right now is the Fed's balance sheet. You can see after the massive quantitative easing that ended in 2022, the Federal Reserve has been doing quantitative tightening for the last couple of years. Now, they recently announced that quantitative tightening will be coming to an end on December 1st. So their balance sheet will remain the same from that point on until they eventually, inevitably start QE yet again. But quantitative tightening does the exact opposite of quantitative easing. Quantitative easing is when they print money to buy assets. It injects liquidity into the financial markets. Quantitative tightening, which is what's been happening for the last couple of years as their balance sheet has been declining, withdraws liquidity from financial markets. They've been doing this on purpose to deal with all the inflation they unleashed from all the money printing. And it has been successful in reducing liquidity in the financial system, as evidenced by the reverse repo facility declining in usage. This is the account at the Fed where banks go to dump their excess reserves. And you can see over the last couple of years, this has gone to zero. So quantitative tightening for the last couple of years has drained excess reserves in the system to basically zero. But why is it that only recently the standing repo facility has been getting massive usage out of it? Again, the standing repo facility is where banks go when there's not enough liquidity. So why now? Well, it mostly has to do with this, which is the Treasury General Account. The Treasury General Account is the United States government's checking account. Every time they take $1 from you in taxes or they borrow $1 from JP Morgan, all of those dollars go into the Treasury General Account, which is the federal government's checking account. And then anytime they spend any money, it goes out of there. Well, what has the government been doing for the past month? Not spending money. Well, it's been spending money, but it's been spending a lot less money because of the government shutdown. So if we zoom in on just the recent portion of this chart, we can see a recent huge spike in the Treasury General Account to the point where now there's $957 billion in the Treasury General Account because the government's still taking your dollars in taxes and the government's still borrowing more money because this isn't a debt ceiling shutdown. It's just a disagreement about the discretionary portion of the budget. And so they're still getting dollars into the Treasury General Account. They're just not spending as many, which means this Treasury General Account is spiking. Now, the Treasury General Account is outside of the financial system. It used to be part of the banking system. It used to be an account in the banking system just like other bank accounts. But you can see here the Treasury General Account started to get used in 2008. And that's because at that time, the Federal Reserve wanted to make sure that all of the quantitative easing and money printing wouldn't cause issues with excess deposits in the banking system. So they had the federal government's account moved out of the banking system, and now it's just a separate account held at the Fed themselves. So the United States government doesn't keep their checking account inside the banking system anymore. They just have their account directly with the Fed. And that means that any dollars flowing into the Treasury General Account are dollars that are right now leaving the financial system. So for the last couple of years, we've had quantitative tightening, which takes dollars out of circulation. This has resulted in the $2.5 trillion of excess reserves going to zero. And now over the last month, we have seen the Treasury General Account spike to $957 billion as the US government has been spending a lot less because of the shutdown. And that means that banks are having to run to the Federal Reserve to say, hey, please give me some short-term cash because I don't have enough. So the answer to the question of why this is happening right now is A, the last couple of years, the Fed has been draining liquidity from the system in order to undo all the excess liquidity they pumped in 2020 and 2021. Over the last month, the Treasury General Account has been sucking even more cash out of the financial system because they're still taking just as much out, but they're just not putting as much back in as they normally do. As a result, banks don't have the liquidity they need, so they're running to the Federal Reserve to get it. Now, the second question, is this a cause for concern? Well, in my opinion, the short answer answer is no, but the long answer is it depends. Because if you go back a little bit in time, this is actually something that has led to major causes for concern, sometimes the biggest. So if we zoom out on this chart, which is the Federal Reserve's intervention in the repo market, we can see the last time that we had a spike bigger than what we're seeing right now is 2019. And before that, it was the financial crisis. And that's because when banks don't have the liquidity they need, they shut down, sometimes within one day. That is exactly what happened during the Great Financial Crisis, when all of the banks had a bunch of collateral, but that collateral was mortgage-backed securities. And when they all realized it was bad collateral, none of them would accept it as collateral from each other for overnight cash. So the banks that couldn't get cash because they had too much bad collateral started to collapse. This would have happened to every single one of them, except for the Fed intervened and decided to be the one who bought all that bad collateral and gave the banks the liquidity they needed. This is why during 2019, when banks started asking for liquidity again and couldn't get it from each other, everybody started to freak out, thinking it was a repeat of the financial crisis. But in 2019, it wasn't an issue with bad collateral, it was an issue of low liquidity, just not enough cash in the system. And that is because underneath the administration at the time, the government had been spending and borrowing way more than it had in a very long time, sucking the financial system dry. And if we look at the Treasury general account, we can see that that's exactly what is happening again this time. Now, in 2019 and during the Great Financial Crisis, the Federal Reserve did not have what they have now, which is called a standing repo facility, which means at those times, they had to make an active decision. Are we going to intervene in the repo market or are we not going to intervene? This is why during 2019, we saw the repo rate spike, which is what caused so many people to have so much concern. Because as banks went to go get cash from each other, they couldn't, so the interest rate started to spike. But as of 2021, the Federal Reserve created something called the Standing Repo Facility, which just means they're always ready to intervene in the repo market with that facility for any amount necessary. And because they maintain the minimum bid rate on the standing repo facility, it ensures that we don't get a repo rate spike, because anytime there are liquidity needs in the financial system greater than what the financial system can handle, instead of paying higher interest rates, they just go to the Fed to get it. And that's why we didn't see any change in the standing repo facility interest rate, because the Fed just prints what is necessary. It's also why we didn't see any spike in the secured overnight financing rate, which is the rate that replaced LIBOR. So we didn't get any spikes in interest rates, and that's just because ever since 2021, the Fed has this facility called the Standing Repo Facility. It's an account that's ready and waiting to be used anytime the financial system needs liquidity. And so even though we got this massive spike in usage, the liquidity is there. So what is going to happen next as a result? Well, number one, like I mentioned at the beginning of the call, the Federal Reserve is putting an end to quantitative tightening as of December 1st. So even if the liquidity conditions worsen over the next month, as of December 1st, they will start to get better. And the reason why is because they're not just going to maintain their balance sheet with an equal composition of everything on their balance sheet. In fact, they're going to be doing a stealth QE and providing liquidity to the market through buying T-bills, and they're going to be doing that by letting mortgage-backed securities run off their balance sheet. So even though their balance sheet will stay the same at approximately $6.5 trillion, they'll still be buying more and more Treasury bills as those mortgage-backed securities run off their balance sheet. In terms of liquidity for financial institutions, this will be a positive, a net benefit. Now, the other thing is actual QE will have to restart at some point, and probably soon here, probably within Q1 of 2026. The reason why is because we have a federal government that is running $2 trillion annual deficits and growing every single year with no signs of slowing down. A central bank cannot keep a balance sheet at the same level in that environment. It has to monetize that debt at some point. And given the fact that bank reserves are around $3 trillion, and if we zoom in recently, we can see it starting to dip down. And given the fact that we know the Federal Reserve wants bank reserves to stay around $3 trillion, doesn't want them dipping too low. It means that the Federal Reserve maintaining the same size balance sheet is not going to last long. They're going to have to restart QE again, probably within the next few months. And the final thing to note is most of these liquidity issues are being caused by the government shutdown happening just right now. With a $957 billion Treasury general account and growing, sucking liquidity out of the financial system, it is going to make these short-term liquidity issues consistent and possibly growing until the government shutdown ends. But once that government shutdown ends, all of that pent-up spending from the US government is flooding out all at once, which is going to be a burst of sudden temporary liquidity to undo all of the temporary tightening the Treasury General account had caused up until now. It is very unlikely, in my opinion, this has any meaningful impacts on markets or the economy overall. Even financial institutions are going to be okay because they're just going to tap the standing repo facility at the Fed. So for the short term, we will probably see more volatility, probably see more liquidity issues. Once the government shutdown ends, we're going to see a burst of liquidity as all that pent up money gets spent. But over the next couple of months, we will see liquidity deteriorate slowly as financial conditions tighten, forcing at some point the Federal Reserve to start up QE yet again, even though they'll already be doing stealth QE by keeping their balance sheet the same and rotating out of mortgage-backed securities into Treasury bills. That won't be enough for the long term. Hope that explanation helps and allows you to avoid some of the people out there saying that this is going to cause the collapse of the entire financial system, and also helps you avoid everybody on the other side saying, pay no attention to the man behind the green curtain. As always, thank you so much for watching. Have a great day.